Hi, welcome to this video today, which is all about the world's best hedge fund traders and what you can learn from them. Now, in terms of individual hedge fund traders, we've covered plenty of them in individual videos. Traders like George Soros, Paul Tudor-Jones, Jim Rogers, Ray Dalio, the real best of the best, okay? Now, you can go and obviously watch those videos. In this video, what I want to do is talk in general terms, what the best have in common and the techniques that you can learn and implement in your own strategy. Now, in terms of the hedge fund industry, there's general public perception they all tend to make money. Nothing could be further from the truth. There's the elite, the best, a small minority. And then there's a majority who do make money for themselves, okay? They don't make money for their investors. They make money for themselves in a certain way. If you actually learn what they do, you can do the exact opposite and it will be guaranteed to increase the profitability of your strategy. Now, I know that sounds kind of paradoxical, but it will all become clear in a moment. Let's go to a storyboard and learn the techniques of the top traders and also look at that technique which you need not to do. You're going to do the opposite and it'll enhance your profitability. Right, let's go through the key points. All right, let's have a look at hedge funds in more detail and what we can learn from them. Obviously, they're just by definition, they invest in a wide range of investments. They can include anything really, stocks, bonds, commodities, also complex derivatives. They engage in long and short strategies, hence the name hedge fund, where it came from. They're very leveraged. They're also normally less liquid than mutual funds, holding less money in cash. Compensation tends to be management and performance 2-20, so 2% management fee, 20% performance, and they also earn a percentage of the dealing fees, many of them as well. They're unregulated by the Securities and Exchange Commission. They tend to be offshore partnerships, many on tropical islands. They're really for the bigger investor who's got $1 million plus to invest. Now, in terms of the good hedge funds, okay, and yeah, really how it all started. Perhaps not by pure definition was it a hedge fund. Commodities Corporation, started by Amos Hofstetter, had a huge array of talent at that fund, which went on. Or the people at the fund went on to have very successful hedge funds. People like, your Michael Marcuses, your Bruce Kovanars, other great traders there like Ed Sakota. Probably the biggest array of talent ever at a fund. Then there was one of the pioneers in the hedge fund industry, Ed Thorpe, Princeton Partners, most famous being Quantum Fund, George Soros, Jim Rogers, and Stanley Druckenmiller. And when they came into the market, they're real pioneers, really fantastic traders, and they all made a lot of money, okay? An interesting fact is that if you invested with George Soros Quantum Fund in 1969, by 1999 when he finished the fund effectively, 100,000 investment would have grown to a whopping 420 billion. And these people really created the mystique around hedge funds and the perception that the industry was a fantastic one to invest in, because obviously they all had great track records. Obviously there were hedge funds that didn't do so well, but the public perception of hedge funds, I think, came from these guys and the mystique also. Now, as we moved on, let's say into the late 90s, you had a lot of people just getting in the industry, calling themselves hedge funds, and they weren't too good. Prime example being long-term capital management. It was a fund that had academically brilliant people at it. I think it had 3 Nobel Prize winners alone. The fund was a disaster. It blew up. It showed that many hedge funds were over leveraging, cash reserves weren't enough, and the government or the Fed had to bail them out. That was one of the worst things that's ever happened in financial history, because big banks, big hedge funds saw themselves as too big to go down. They'd have to be saved. And we all know what happened in 2008. Also, as you turned the millennium, you had the rise of the machines. Hedge funds getting more technologically focusing on speed with the high frequency traders, okay? And you had that big focus on technology, which again, a lot of traders think, wow, it must be a fantastic advantage they've got over everyone else. I'll just discuss that in a moment. But in terms of strategies today, it's not like the days of George Soros. Okay, it's a saturated playing field. A huge amount of money is involved. You know, hedge funds can't get the discrepancies in price they used to, or intimidate like they used to. When I say intimidate, think of George Soros. When the Bank of England wanted to defend the British pound, George Soros had enough funds with leverage, more than double, to defeat them. And he knew he could. That will never happen again. So it's a bit of a harder playing field today, I think. Best funds, in terms of really two areas hedge funds are focused on, the majority. There's some, or proportion, who are global macro. So they're seeking out opportunities anywhere they can find them in the world, and they tend to be longer term. Then you have the high frequency trading systems with the shorter term focus. Also a lot of technical funds with a shorter term focus. Now, in terms of which group does better, it's global macro. Okay. Overall, the hedge fund industry, and many people find this fact surprising, has performed dreadfully overall. Obviously, there's exceptions, as we've noted with George Soros, etc. But if you take this fact, and it comes from Simon Lacker's book, The Hedge Fund Mirage, since 1989, if you'd invested in T-bill interest rather than a hedge fund, you'd been better off by 100%. Okay? I put BC minus 1.55. That is Barclays Capital Index of hedge funds at the time of me doing this video, what they have lost on average year on year. So they're down by that amount over the last year. That is obviously a poor performance. Also, even worse is that the figures that we've got here actually admit all the hedge funds that were shut down or just blew up. Okay, the figures would have been obviously even worse if they'd have been included in Lacker's data. So terrible performance overall, but exceptions in there. Obviously, certainly from the early days, today you've got great hedge fund managers still, like Jim Leitner, for example, but generally don't do well. So what lessons can you learn from the hedge funds? Well, it's just the lessons of what good traders do and what bad traders do. The good hedge fund managers focus on the longer term. They avoid noise, and the really good ones make money, just as the really good retail traders who do that make money. Now, in terms of the shorter term, technology does provide an edge to the HFTs. There's no question. A retail trader needs to be aware that you can never compete with them. They're so fast in the way they trade, and they spend millions or hundreds of millions developing fast systems. Now, do these fast systems make money? Well, they do, but they make money in a way that is just basically fees. So they do so many trades, they pile up a load of fees, and the actual performance in terms of money made under management is not great, but the fees are, and they make it out of retail traders by attacking their stops, front running their orders, etc. They should actually be banned or restrained. It hasn't happened yet. Generally, if you look at the hedge fund industry overall, the reason it's done so badly is the ludicrous fees they charge. I mean, the management performance fees, they'd be fair enough, but how many hedge funds take a cut of the dealing fees? Huge percentage, and Lacker worked out that could be up to 30% of equity per year generated back in fees. Every million they've got, they'll generate 300,000 back in fees. Doesn't matter if the hedge fund loses or not, does it? They're just making so much money. And in terms of this, it's called churn and burn. Basically, just churn over the equity and burn it, make it back for yourself in fees. The fund might lose. You see plenty of hedge funds that shut down because their performance is so poor. People at the hedge fund then go and open up another one. The sort of perception of the public is these guys do well, and overall they don't. Okay, and Warren Buffett has often attacked the hedge fund industry for, making too much money in terms of fees, not having a good performance. You've seen a lot of pension funds in recent years who put money with hedge funds withdraw the money. I think California was a really big one. So don't do well. The good ones, stress it again, they do what good traders do anywhere. Focus on the longer term. You've got to exclude HFTs in terms of your own trading, obviously, or frequent trading, because they're making money in a different way. Okay. What else have you got? You're not focused on fees, okay, as a retail trader, which means you can be very patient. You can only take the best opportunities, okay? That's what you should be focused on. Few trades a month, you can easily beat that average hedge fund with its minus 1.55%. So I think, if you look at hedge funds overall, the ones that do well just do what good traders do. The ones that don't do so well, obviously too focused on making money. And one thing I would say is, generally technology not a great help in forex trading at all. Okay, in terms of making money on the money invested. Okay, and long-term capital management, perfect example of this. And also that, brilliant minds do not necessarily make money. They were so arrogant about how good they were. They got their comeuppance when the fund went down. It's just a shame they got bailed out. So you don't need to be intimidated by hedge funds. What you could basically learn from them are the basics of being a successful trader. Longer term, patience, and just basically, always keep in mind all the information, all the technology that hedge funds have has not really given them overall a great performance. Also, traders should keep in mind with people like Ed Thorpe, George Soros, that their strategies were relatively simple. Okay, they weren't relying on really complex technology. I mean, Ed Thorpe, the pioneer of algorithmic trading, kept his trading strategies brutally simple. They were not complex algorithms. Okay, so that is my summary of hedge funds and what you can learn from them. I'm sure a lot of people will be disappointed there was no secrets that they've got. They don't really. And you could say the HFT, high frequency traders, I've got a little bit of secrecy about them. That's because, in my view, they're doing things unethically. A lot of people agree with it. I think they will eventually be reined in or banned. But just basic knowledge of hedge funds, I think, is good for any trader, because then you realise you're not at a disadvantage to the so-called big boys. Not only can you compete with them, I'm sure most traders could beat minus 1.55% in a year. And that's just a typical performance year on year for them. Right, that is the video for today. Thank you very much for watching me. Take care. Have a good day.